Hello, I am modeling GoodRx today using my discounted cash flow analysis. Being an analyst for Seeking Alpha, I like to refer to Seeking Alpha data. So for my year one revenue, I'm going to look at management's estimate for 2026, which I'm pulling up an earnings transcript here, and they have they expect revenue between $765 and $785 million. So I'm going to input the midpoint of that, which is 775. Right now, looks like 1 quarter has passed for this year. So the fraction of the year elapsed simply accounts for this. It adjusts the timing. So it tells the model to assume that 1 quarter of free cash flow has been realized. And the big ones are revenue growth and free cash flow margin. Now, GoodRx does generate cash from operations, and naturally it doesn't have much capital expenditures. So we have in the trailing 12 months about 170 in cash from operations minus 4.5 capital expenditures, and then divided by the revenue in the trailing 12 months, which is 787.9. That's a free cash flow margin of 21. And just double checking what Seeking Alpha has as the levered free cash flow margin, which is 10. Let's see if management has any expectations for free cash flow margin. Some of them will guide for free cash flow, but not all of them. I'm just looking at press releases and doing searches for free cash flow. They really just guide for revenue and adjusted EBITDA. I'm gonna lean conservative here and go with 15%. And now, you know what, I'm gonna see what they're doing with revenue growth. I'm looking at the trends. Looks like things have slowed down to like 0% in the trailing 12 months, or negative 1%. And then earnings estimates, so it looks like there's an expectation that growth is going to gradually rise within the next few years and then fall back. So let's see. The expectation for next year is 5.51% year over year revenue growth. So it's 5 and then 10 and then back. Oh no, that's not accelerating. I need to go to yeah, peak mid-cycle. That's what I was trying to do there. So 8. So that's pretty reasonable, actually. 7 and 15. Okay, so I have my first 4 inputs in, and you can see I added the growth profile. Before I just had it really is CAGR, but having a growth profile is more realistic. But I ended up finding out that the growth profile doesn't actually make much difference when it comes to the valuation, and I can demonstrate that once I have more inputs in. So we're looking at beta for GoodRx, and we are definitely not just going off of stock beta, which is 0.8 according to Seeking Alpha over the last 24 months. Assuming GoodRx doesn't have a bunch of debt, beta is what is going to drive the discount rate. Well, they do have a lot of debt actually, but the beta is that's still too low for, you know, a small cap company that has a lot of competition and not much at all of a moat. So in this case, it's going to end up being a blended beta, and I'm going to go off of New York University Stern betas to kind of get an idea of what an average beta is for the industry that GoodRx is in. Let's see. I'm just looking at all the different industries it has listed and trying to figure out what's most appropriate to use for GoodRx. I mean, GoodRx is arguably a software company. They have a very software-like business. Yeah, it's digital health. We have a system and application software industry beta of 1.28. And GoodRx is so small, it's not even 1 billion market cap. There's a lot of risk there. I'm gonna go with 1.5, and I can do a sensitivity analysis to, in case this assumption is off. This is an assumption that I would isolate. All right, so risk-free rate. I know risk-free rate keeps going up, so I'm gonna have to update this one. It's like the latest 10-year treasury was 4.68. Crazy. Market risk premium usually stays at 5. What is GoodRx's cost of debt? Looks like it's about 8.2% for the cost of debt. Tax rate's always going to be about 21%. Terminal growth, just going to put it at 2. I usually do between 2 and 3. Obviously GoodRx is not growing, so they're going to get hit with the 2%. Now I'm going to look at their 10Q. Got to figure out how much debt they have. Why is this messed up? Oh my goodness. It's getting some really weird stuff here. Okay. SEC filings. GoodRx. There's the 10Q. We're going to look at debt. Current. It's 5 million. We have net debt 482. Say 482 for debt, cash and short-term equivalents. I'm just gonna go off the seeking alpha value for this. Okay, 235. Say 236. Wow. All right, current stock price. It's 252. Shares outstanding. I'm just copying and pasting from Seeking Alpha. This is really irrelevant. This is really. I also made a dynamic DCF module, but it just hasn't been relevant. It combines the DCF and a couple other valuation methodologies, but I just haven't figured out how to incorporate it. So both of these inputs are pretty meaningless. Industry, this doesn't really impact anything. It's for other modules in this, but I'm going to keep it a technology. Growth volatility, margin volatility, that's for the Monte Carlo simulation. I usually don't mess with that too much unless things are very volatile or vice versa. Growth margin correlation, share drift volatility. That's one thing I need to look at, is how GoodRx is shares outstanding, or how they're trending. Ooh. It looks like they've actually decreased. They probably do, like, they're generating so much cash, I'm sure they do some share buybacks. Looks like they have an active 450 million share repurchase program. I don't want to be too aggressive with my assumption here because okay. So you can see, and this is not surprising for GoodRx because its valuation is so the DCF value per share comes out nearly 121% over the current stock price. This is not typical. Usually when I make the inputs, it comes pretty close. So something's not right here. Yeah, something's not right here. So this is when I kind of relook at my inputs that I used and okay. Now, I think my discount rate came up pretty reasonable at 10.12%. I'm not mad at that. I mean, there's probably something going on with my revenue growth assumption. It's premium, risk-free rates. that's pretty reasonable. I actually did I did a valuation assessment of GoodRx when I last wrote about it. That was October of last year. Let's see what's changed. Yeah, it's probably the revenue growth that's throwing things off. I think the consensus analyst estimates are probably way too optimistic. I had revenue growth at 2.5%. That was more like a CAGR because that was before I added a growth profile feature. My WAC discount rate was 9.41% back then, which was probably too low. That again, the stock is considerably cheaper since then. It was $4.44 last October, and now it's $2 and oh wow, so it really, my DCF value per share back then was $4.70. So it's actually pretty close to what I've modeled already. But, you know, some things have changed. The shares are outstanding have dropped. I went with a higher discount rate this time around. And it can often be the case when you have a result like this. But there's just so much pessimism built in. There's something that, you know, the consensus analyst estimates aren't accounting for yet, like some kind of revenue cliff or like major change in the market with competition. So obviously, I mean, this is what the market is. The market evidently believes that GoodRx is not going to see any growth. So this is going to be my bull case for GoodRx, that it's able to return to growth in a big way. I mean, going all the way back to 7.5% growth, maintain those free cash flow margins, cut down on shares 1% every year. So this is a fine bull case that they kind of turn things around, because obviously things are headed in the wrong direction, and that's kind of what the market is pricing GoodRx for. And yeah, I mean, it's very obvious when you look at year-over-year revenue growth in the past 1, 2, 3, 4 years. It's been, you know, it was 0% last year, 5%, 2024, negative 2%, 2023, 2% in 2022. So what I did was inadvertently I modeled for a bull case where GoodRx is able to return to growth in this case, then its stock would see this, but that is merely the bull case. So it's included in my scenario comparison. Now I want to find out what the stock is actually priced for, and for some kind of combination of things. So it's saying 1.3 and 11. So yeah, and this is kind of what it looks like the market is pricing GoodRx for. Kind of, I mean, basically no growth. You can see even when I change the growth profile doesn't really have much of an impact. But you know, it's when you run into a situation like this, when you get to the point where the growth expectations are lower than the terminal growth expectations, it just doesn't really make any sense anymore. Yeah, this is rough. I mean, is it possible that GoodRx is essentially being priced as if it's already at terminal growth? And I mean, that seems consistent with how its business has looked since 2022. So, you know, you can't really blame the market for having these kinds of assumptions. So, you know, if GoodRx, if they're able, and this is the free cash flow margin, that was really the levered free cash flow margin that I referenced earlier, which was at 10.7%. Which is very interesting. I can probably drop that to 11. Okay, so I mean, yeah, it's basically a terminal growth. Yeah, so and I think this is informative. I think this shows us that the market is pricing GoodRx as if it has reached terminal growth. So if you have this knowledge as an investor, you can then, you know, use this information. You know, for instance, if you think that, you know, there's a really good growth opportunity for GoodRx, and it ends up growing beyond its terminal growth assumptions, that would result in massive upside. At the same time, with the amount of debt it has compared to its cash, there's still also potential for a lot of downside, and especially because it's so debt dependent, and this is going to show up when I look at a sensitivity analysis. So this is our base case. This is, in my opinion, this is what the market is valuing GoodRx for. And it totally makes sense because this is kind of what GoodRx has been doing the past few years. So we have our bull case, we have our base case, and you know, what would a bear case look like? It would probably, it wouldn't look good. I mean, wow. might be able to tell, I'm not used to, you know, when I do these DCF models, I'm usually doing it on like high growth stocks, like, you know, software as a service, like Snowflake. So I'm not, you know, when it gets to the point where you're modeling for revenue growth that's essentially the same as terminal growth, things get a little dicey. You know, it's just like the expectations are so low in GoodRx that the bear case would be that its business just declines. I mean, there's no other way to put it. You know, what kind of decline might we be looking at here? Well, for one, this amount of year one revenue assumes year-over-year growth of negative 0.263%. So, you know, what would things look like once if they start losing? And, you know, if revenue growth really looks like that, you know, there's no way that the free cash flow margins are gonna hold steady. So I think you kind of have to penalize them for that as well, because I imagine they would be spending some money to try to reignite their growth. Yeah, wow. And obviously, I don't think I can actually model a negative terminal growth, so we'll just keep that at 1.5. So yeah, it's getting quite dicey here. So yeah, base case, usually I give that more weight. Feel comfortable with my base case. Honestly, I'm gonna give it more weight than I usually do. Bear case, I mean, I don't know, man. It's really hard to discount the bear case too much because that's what they're doing right now. So I would argue more weight. And obviously there's no specific formula that goes into this. This is me just, that's supposed to be 20. Yeah. So it, based on normalized weights, it comes out to around the valuation, and this kind of shows you. Now, realized CAGR is the actual CAGR over the 9-year projection period. This input is just base revenue growth, and then the growth profile tells you how it looks, and that's also, well, I thought it was shown down here, but it's not. But yeah, it's you can see it clearly. It breaks it down right there. So this is the scenario comparison. Now, going back to the base case, you can see that really it's any combination of this. Yeah, this is what I want to look at. It should not be this. Make adjustments here. 661. 6 is just too much. 4. Alright, so this kind of puts things in perspective. This shows us how changes to growth and free cash flow margin change the valuation. It also tells us that margin expansion is key. So this is our base expectation highlighted in yellow right here. Growth of 2%, free cash flow margin of 10.5%. You know, what if the company is really able to improve their profitability and they jump 12.5%, and the growth assumption stays the same. Well, it'd be priced at $3.11. What if their base revenue growth assumption increases? Oh, that looks terrible. It's a visual change. I'm gonna have to. Okay, so cash flow margin. This is obviously tornado visual here. Usually you'll see revenue growth and free cash flow margin up top. It's good that it isolates for beta as well, because you can see beta has a large impact. What a year one revenue? What if they beat? It would change that year one input, which doesn't have a huge impact on the valuation, but it does change all subsequent years. Beta anywhere between 1.2 and 1.8. It's good to look at, but I feel pretty confident with my beta of 1.5. If anything, I mean, given how GoodRx is structured and all the risks, and I think I'm pretty comfortable with my discount rate as it is. Risk-free rate, I guess that could change a little bit, right? It's been changing so much. Tax rate, nah, I don't really need to show that. Risk-free rate, terminal growth, yeah, that's a good one to keep. Cost of debt, I guess. That does make a big difference because it impacts the discount rate. That's a pretty good range. Beta 0.3, terminal growth. And the big kickers are going to be a revenue growth and free cash flow margin, as is usually the case. Yeah, especially free cash flow margin, because I only have this, the range set to plus or minus 1, and yet it's all the way up here. Revenue growth is plus or minus 2 percentage points, and it's pretty close. So, yeah, it's going to be that free cash flow margin. Alright, and then I want to look at the Monte Carlo simulation here. I'm going to run it on my base case. Yeah, nothing particularly surprising here. I'm really interested in the 5th percentile, 95th percentile values. This kind of tells us that keeping all the assumptions the same, GoodRx could feasibly trade down to $0.93 before it becomes unreasonably underpriced, versus $6.42. In that event, it would become unreasonably overpriced. And then this gives us a probability distribution of the possible share prices, because the single point estimate can be misleading.